Welcome to the deep dive. We know you've been looking into potential hypergrowth stock investments. And, well, we might have something interesting for you today.
Oh, yeah. What have we got?
It's an article from the Motley Fool, actually dated today, April 14th, 2025. They've picked out a specific company, New Holdings. You probably know it as Nubank.
Nubank. Okay.
And they're making a pretty strong case for why someone might consider putting, say, $1,000 into it right now as a hypergrowth play.
Right. And the Motley Fool, for anyone, less familiar, they're a big financial services company. Their whole thing is making the world smarter, happier, and richer.
That's the one.
They reach loads of people.
Yeah.
Through Fool.com. That's where this free guidance comes from. Plus premium stuff. Podcasts.
Exactly. And this isn't just a quick tip. The article lays out 5 specific reasons why they're, so keen on Nubank right now.
5 reasons. Okay.
So that's what we're going to do in this deep dive. Really unpack those 5 points, see what the thinking is behind this recommendation.
Sounds good. And it's interesting they mentioned the market backdrop, too.
Yeah, this sort of fear about a potential recession, something about unpredictable tariffs pushing people towards safer bets.
Which, as the article points out, can sometimes be exactly the moment for, contrarian thinking, looking long-term when others are nervous.
A potential opportunity, then.
Could be. So, with that stage set, let's dive into reason number 1 they give.
Okay, reason 1. Explosive growth. They start with Nubank, being based in Brazil, obviously, but also expanding into Mexico and Colombia, big markets.
Right, and a key driver they highlight is that neobank model, being digital only. They argue it just lets them expand way faster than the old school banks with branches everywhere in that region.
Makes sense.
Less baggage, I suppose.
Totally. No physical branches means lower overhead, quicker scaling, and they back this up with some, pretty dramatic numbers.
Yeah, like what?
Get this. Between 2021 and 2024, the customer base more than tripled.
Tripled, wow.
Yeah, from about 33 million to over 114 million. That's massive acquisition speed.
And are people actually using the accounts or just signing up?
Good question. The article says the activity rate, the percentage of active customers actually increased too, went from 76% up to 83% in that same time frame.
Okay, so they're sticky. People are signing up and engaging.
Exactly. They're not just dormant accounts. And that activity naturally flows through to the top line.
Revenue growth.
Oh, yeah. An 89% compound annual growth rate, CAGR, in revenue. And that's in U.S. dollars, mind you, between 21 and 24.
89% CAGR. Okay, that definitely screams hypergrowth.
And it really does.
So what's fueling this? The article mentions the platform's simplicity and building out their ecosystem.
Yeah, both are key. Simplicity makes it easy to join and use. And then they've been smart about adding more services. It's not just a basic bank account anymore.
Like what else?
Well, the usual checking and debit, credit cards, lending, but also insurance, investments, even crypto stuff, e-commerce links, and now business services too.
So they're trying to be the main financial hub for their customers.
Pretty much. Keep everything in one place, digitally smooth. That builds loyalty, makes it harder for people to leave.
Right, that makes sense. Okay, let's move to reason number 2. Soaring profits. Growth is great, but you need profits eventually. How's Nubank doing there?
This is maybe even more impressive. Despite that crazy customer growth, their cost to actually serve each active customer stayed flat.
Flat, even with tripling users.
Yep. Just $1.80 per month per active customer on average from 2021 to 2024. It didn't budge.
Wow. That really speaks to the efficiency of that digital model, doesn't it?
It absolutely does. Shows they can scale without proportionally scaling cost.
And that efficiency must be helping their margins.
Definitely. The gross margin jumped from 36% to 46% over that same period.
Okay, so they're making more profit from each dollar of revenue.
Exactly. Becoming more efficient as they grow. And the big milestone the article flags is hitting GAAP profitability in 2023.
Right, GAAP. Generally accepted accounting principles. That's a serious hurdle for growth companies. So real standardized profits.
Real profits. And it wasn't a one-off. GAAP earnings per share, or EPS, grew another 30% in 2024.
So the profit trend is continuing. How are they managing costs so well? AI and stuff.
Yeah, the article mentions things like AI analytics, automation where possible, using chatbots for customer service, leveraging tech not just for growth, but for efficiency too.
Smart. Okay, reason 3, fertile market. This is about the opportunity in Latin America, right? The unbanked population.
Exactly. They cite World Bank data from 2021. Around 122 million people in Latin America were unbanked.
122 million. How much is that percentage-wise?
That was about 26% of the region's population back then.
26% compared to the U.S.
Much lower here.
Yeah.
The FDIC estimated only about 4.5% unbanked in the U.S. in the same year.
Huge difference. So the potential pool for Nubank is just massive.
It really is. If they stay the leading neobank, there's just a huge runway for getting new users.
And the article talks about stickiness again. Scale creating an advantage.
Yeah, the idea is as they get bigger and offer more services, it becomes much harder for smaller competitors to challenge them. It creates a kind of moat.
Network effects, basically. More users, more services, makes it better for everyone, harder to leave.
Precisely.
All right, reason 4. Attractive valuation relative to growth. Now we're talking stock price. Is it cheap for the growth you're potentially getting?
That's the argument. Despite all this growth, the article suggests the stock might actually be, well, undervalued.
How so? Projections.
They point to analyst projections for the next few years, 24 to 27, expecting revenue to CAGR still around 32% and EPS RER around 27%.
Still very strong growth expected then. What about the current valuation metrics like price to earnings?
Yeah, at the time the article was written, it was trading around 21 times forward earnings,
Okay.
expected next year earnings,
Okay.
and less than 4 times this year's projected sales, which for that kind of growth outlook, you could argue is pretty reasonable, maybe even low.
So why would it be valued like that? Worries about the region.
That seems to be the main factor. Concerns about inflation in Latin America, currencies weakening against the dollar, general political or economic headwinds down there.
Plus maybe wider market stuff like those tariffs and U.S. interest rates we mentioned earlier.
Yeah, all that likely plays a role, making investors a bit cautious about emerging markets generally right now.
So the contrarian play again. If you think those fears are overblown or temporary.
Then maybe now's a good time to look at it while the valuation is potentially compressed.
And they mentioned the IPO price.
Yeah, kind of as a benchmark. The stock was apparently trading only about $1 above its $9 IPO price. The suggestion being, if sentiment improves, there could be decent upside from here.
Interesting point. Okay, final reason, number 5. Warren Buffett's enduring stake. Always gets attention when Buffett's involved.
Doesn't it just? So Berkshire Hathaway, Buffett's company, bought a big chunk at the IPO, 107 million shares.
But they sold some.
They did. They sold about 67 million shares in the second half of 2024.
Selling more than half. Wouldn't that worry some people? Like, Buffett's lost faith.
Well, the article suggests, looking at the context, it might have been part of a wider move by Berkshire to build up cash, move into safer short-term treasuries, maybe take some profits when the stock was higher.
Higher. What price was it then?
The article mentions it was trading up in the $13, $15 range around that time.
Ah, okay. So maybe just trimming a position that had done well rather than bailing completely.
That's the interpretation they offer. Like trimming froth in a bubbly market, not a vote against Nubank itself.
Because they still hold a lot.
Exactly. Even after selling, they still held 40 million shares, worth over $400 million at the time of the article.
Right. That's still a very significant holding.
It is. So the fact they kept such a large stake suggests continued belief, especially now the price is lower back in that $9, $10 range the article mentioned.
Makes the lower price look potentially more compelling, as they put it.
That's the idea.
Got it. Now, they also give some practical advice on how to invest, given it's a high-growth stock.
Yes, very important. They stress that stocks like Nubank, these hyper-growth fintechs, can be volatile. Prices can swing quite a bit.
Especially now.
Right. So they advise against just dumping your whole investment sum in at once.
Instead, they recommend dollar cost averaging.
Exactly. Dollar cost averaging.
Can you just quickly explain that again?
Sure. It just means investing a fixed amount of money at regular intervals. So instead of buying $1,000 worth today, maybe you buy $250 worth every month for 4 months or whatever schedule fits.
And the benefit is?
You reduce the risk of buying everything at a peak price. If the price dips, your fixed amount buys more shares. If it rises, it buys fewer. Over time, it averages out your purchase cost.
Smooths out the ride, essentially.
Yeah, helps manage volatility risk, especially for long-term investing in potentially jumpy stocks.
Sensible approach. Okay, so let's just quickly pull together those 5 Motley Fool arguments for Nubank again.
Okay, number 1, that explosive customer and revenue growth. 2, the soaring and, importantly, efficient profitability.
3, the huge, fertile market opportunity in Latin America's unbanked population.
4, what they see as an attractive valuation relative to that ongoing growth potential, especially given current headwinds.
And 5, the fact that Warren Buffett, despite trimming, still holds a very significant stake.
Right. And tying it all together is that advice to consider dollar cost averaging because of the potential volatility.
So for you, our listener, thinking about hypergrowth, this gives a pretty clear picture of why the Motley Fool highlighted Nubank. It covers the growth story, the financials, the market context, the valuation argument.
And I think it leaves you with a really crucial question to ponder, doesn't it?
Which is?
Well, how do you personally weigh that potential for really high growth, like Nubank seems to offer in a market like Latin American Fintech, against the undeniable risks? The volatility, the economic uncertainties of investing internationally, especially in emerging markets.
Yeah, that's the balancing act, isn't it? High potential versus real risk definitely requires more thought and, your own research based on your own situation.
Absolutely. It's about matching the investment to your own tolerance for risk and your long-term goals.